booklet.
Hi there, so welcome to today's show, the Business Lecturer in Within Show. Every Monday to Friday, we host this show at 4 p.m. where I lecture you on various subjects, on various topics for our preparation towards the ICAG May 2020 examination and beyond. If you are just joining the broadcast, comment below with any questions that you are having, and also remember to share the channel with other students so we can together reach as much students as possible. And today we want to take it a step further and continue with our discussion of what we were doing yesterday in relation to the IFRS 15, and we want to take that a step further and look at the final aspect of it. So this is part 2 of the lecture on IFRS 15. In case you are watching the part 2 but you didn't watch the part 1, you can check that out and watch the part 1 where I went through the entire 5-step principles in relation to how we can recognize revenue under IFRS 15, and we solved a couple of questions in relation to revenue allocation, transaction price allocation, and also the final recognition of revenue, but most importantly how we represent the transaction in the financial statement. So remember what I mentioned about this standard, that primarily this standard is replacing 2 major accounting standards, and that is the IAS 18, that is revenue, and then IAS 10, and that is construction contracts. There are other IFRSs that this standard is replacing, but our focus is just on these 2, IFRS, IAS 18, and then IAS 10. So if you just joined the broadcast, it is the Business Lecturer in Within Show. Comment below with any questions, any topics that you want to see more on this channel that you want me to cover. You know that during this live broadcast, I teach based on the topics that I have, based on what students have recommended or have asked me to teach. So if you have any specific topic that you want me to cover, any subjects, management accounting, financial reporting, public sector, financial management, audit and assurance, advanced audit and assurance, principles of tax, advanced taxation, whatever subject it is, corporate reporting, whatever subject it is, strategic case study, whatever subject it is, just put a topic in the comments box or in the chat box, and I'm going to be looking at it. My team will look at it, and then definitely we'll make some content available here live as I lecture you on how you can prepare well for your examination. So let's do a quick recap in relation to what we started with yesterday in IFRS 15. Now, what we mentioned about IFRS 15 yesterday was that the IFRS 15 is replacing 2 old accounting standards, that is the IAS 18 revenue and then IAS 10 construction contracts. Then we mentioned about the fact that the IFRS 15 applies the principle-based approach for revenue recognition. In other words, for us to recognize revenue in accordance with IFRS 15, there are 5 steps that we go through, and I've emphasized about the fact that you cannot do step 1 without, you cannot do step 5 if you have not done step 1, you cannot do step 4 if you have not done step 3. So it follows in that order: 1, 2, 3, 4, and then 5. Then we said that these 5 steps are as follows. Number 1, identification of contracts with a customer. That's the first step. We must identify the contract with a customer. Second, we mentioned that we must identify the performance obligation. That is what we are going to be doing under this contract to the customer in return of the consideration or revenue that we are receiving. And then step 3, we move on to what is called determination of the transaction price. That is how much we actually going to be receiving under this contract. Now, after we determine the transaction price, that is step 3, we came to step 4, and that is the allocation of the transaction price to performance obligation using the standalone prices. Allocation of the transaction price to performance obligation using the standalone prices. And in that regard, we solved a question, and I used an illustration, if you remember that well, and we solved the question under the allocation. Then we said that after we now allocate the transaction price to the performance obligations using their standalone prices, we come to the 5th thing, that is we recognize revenue as or when the performance obligation is satisfied. So these are the 5 steps, and it's a principle-based framework used for the recognition of revenue under IFRS 15 in relation to that. Right, so we solved the question. The conclusion of our discussion yesterday was that we solved a question under called Levertech. And in that question, we were requested to, or the examiner asked us to demonstrate how the transaction will be presented in the financial statements. And you saw the various workings that we did and how we represented the data in the financial statements of the company. So I mentioned that today we will continue with the second aspect. So everything we discussed yesterday was in accordance with IAS 18, just how we recognize revenue relating to IAS 18. So now let's come to the IAS 10 aspect, that is construction contracts. So if a performance obligation is transferred over time, then the completion of the obligation is measured using either the input approach or the output approach. Let me take that again. If performance obligation is transferred over a period of time, then the completion of the performance obligation is what? Recognized or calculated using the input approach or the output approach. So let's say, for instance, we are building, so we are we've got a contract to build a house for a company, all right? So we are a construction company, and we've got a contract to build a house or a head office for a company, and we're going to be using 36 months for the building. That is 3 years. Okay. At the end of the day, how do we allocate or apportion the cost and revenue during each of these 3 years in order for us not to overstate our revenue in 1 year and understate the revenue in another year, and profit and vice versa? So it means that if that is a contract that we have, then our revenue recognition will be based on the percentage of completion. Okay, based on the percentage of completion. So when it comes to the calculation of the percentage of completion, let me do that here. We can use what is called the input method or the output method. So 2 key methods can be used for the determination or computation of the percentage of completion. Now, what is the input about? The input simply means cost incurred to date. So cost incurred to date divided by total cost or total contract cost. Now, this is where you got to be careful about computation of the percentage of completion. Now, when we say cost incurred to date, it includes both the cost the entity has incurred today till date on the project, as well as any materials that they have bought for future use. Let me take that again. When we say cost incurred today, it includes both how much cost that they have incurred to date, as well as what the materials that they have bought for future usage. That is the cost incurred to date. Then when we say the total contract cost includes the cost we've incurred to date and the estimated cost to completion. Okay, so the total contract cost entails two things: cost incurred to date, okay, like the numerator, and then estimated cost to completion. How much cost are we going to be incurring to be able to actually complete with the project? So that is the input method. Now remember, that will be times 100 because it has to be represented in percentages. Now, if we represent this in percentages like this, that percentage is what is going to guide us in relation to how we will apportion the contract profits and also how we allocate the contract revenue, thereby determining the cost of sales in the income statement. Don't worry, we will get into that in a moment. Now, with the output method, this is where we're going to be using work certified over the contract, the total contract revenue. So work certified over the total contract cost. Sorry, total contract revenue times 100. So either we're using the input approach to compute the percentage of completion, or we are using what? The output approach to compute the percentage of completion. Either way, what is going to be happening is that with the output approach, we are using work certified. Now, what is work certified? Work certified simply means the work that we've done so far that is due to be acceptable in the eye of the architect or in the eye of experts. All right, so that is the work certified. So when we take the work certified divided by the total contract revenue, that will give us what we refer to as the output approach to be able to compute the percentage of completion. Now, so I made a statement that either we are using the input approach or output approach, the objective of the computation is to be able to allocate contract profits and also allocate the revenue. So let's go through these principles very well. When we are dealing with issues such as that, where the performance obligation is spread over a period of time, or we are dealing with a construction contract question like that, the first thing we need to calculate is to determine whether we have made profit or loss on the contract that we are undertaking. So what we bring is that we bring contract revenue. So we're going to have our contract revenue. Then we will bring the total contract cost. The total contract cost. Now, the total contract cost is the same as how much we are going to be incurring to finish what? The job. Okay? So the total contract cost. When we subtract that, this is going to give us either a profit or a loss. When it's a positive, it's a profit. When it's a positive, it's a profit. When it's negative, it is a loss. But the key question is, how do we account for this? That is the most important thing. If we compute profit or loss on the contract as a whole, and it gives us a profit, then we allocate that profit based on the percentage of completion or the stage of completion. Please get this carefully. If we calculate the profit on the contract, and we calculate profit or loss on the contract, and we get a profit, whatever amount of profit we will get, we will take a percentage of that, and the percentage of that we will take will be the percentage of what? Completion, or the stage of completion. That same thing will apply to the revenue. So what does that mean then? It means that if you come to your statement of financial performance, you are going to be bringing revenue. Please know that the revenue you are bringing here can be two things. One, the revenue can be the same as the work certified, okay? Or the revenue can be the stage of completion times the contract's revenue or the contract price. So these two are the ways that the revenue is computed. I want you to make sure you understand what we're doing very well. So if we are preparing the statement of financial performance, our revenue can be the work certified. So if in the question we are giving work certified, that work certified could be the same as what? Our revenue. However, in other cases, we're going to be taking the revenue as what? A percentage of the contract revenue. Once we get that, we pretend to close this account, then we will bring the profit. That is, if you made a profit, we will bring the profit. Now, the profit we computed here, we will take a percentage of that profit based on the stage of completion. So a percentage of the profit will be brought here. The balancing figure will be referred to as cost of sales. I'll be getting the picture. The balancing figure will be referred to as cost of sales. So if you are preparing the statement of financial performance for the company, what we do is that the first thing you do is the stage of completion has to be computed. Second thing, you calculate the contract profit or loss. If it is a profit, this is what we do about it. Now, what if we compute the contract profit or loss and we get a loss? If we get a loss, the standard states that the loss should be written off in the current year under consideration. If it is a profit, you will take a percentage of it and recognize it in the statement of financial performance. But if you made a loss, the whole loss will be written off in the current year under consideration. So that is a principle on what you must understand in relation to dealing with the issue like that. But at the end of the day, what is going to happen is that we must recognize contract asset or contract liability in the statement of financial position. So after we prepare the statement of financial performance, we must recognize contract asset or contract liability in the statement of financial position. So pro forma wise, how is that going to be? The presentation of how we get our contract asset or contract liability is as follows. So we bring our revenue sign, then we bring cost incurred to date. Did I say revenue sign? Currency sign, okay? So currency sign. So cost incurred to date, that's the first thing we bring. Then if we recognize profit, so recognize profit or loss. So if you recognize the profit that you are recognizing here, okay, that's what you bring here. If it wasn't a profit and it was a loss too, you bring it. So one of them will be present. Either you are making a profit on the contract or you are making a loss on the contract. Once you bring that, you bring your receivables, and that is the amount you invoice to the customer. Is deducted. Then the balancing figure will be treated as contract assets. If it is a positive, but it becomes contract liability if it's a negative. Okay, so this is the pro forma on how we are going to be accounting for. This is for the statement of financial position. So in our statement of financial position, to show the contract asset or liability, this is what we do. So what have we said so far? Number one, we've said that when performance obligation spans over a period of time and it's about construction contracts, the first thing you do is to calculate the percentage of completion. Once you finish with the percentage of completion, another thing that you can do simultaneously is to calculate the profit or loss on the contract. Number one, if we made a profit on the contract, in the statement of financial performance, you only take a percentage of that profit and recognize it for the year under consideration. Now, what percentage are you taking? You are using the stage of completion or the work that we have done so far. So whatever calculation you had in the first one, that percentage, you will take a percentage of the profit. That's what you recognize. And your revenue, most importantly, in the statement of financial performance could be either your work certified or that same percentage of work, stage of work completed times the contract revenue, and that will give you what? Your sales figure. If you strike out that figure from your profit that you recognize, the balancing figure gives you the cost of sales in relation to that. But the second thing you must understand is that if the company makes a loss on the contract that they are undertaking, then that loss should be written off in the year that we are looking at. So in that case, we will not have a profit, we will have a loss here, and the cost of sales figure is going to be higher for the current year under consideration. Then the final thing we are talking about is that after we prepare the statement of financial performance, we must represent the balance due from the customer or to the customer in the statement of financial position. And that is what we refer to as the contract asset or the contract liability. And the pro forma is that we bring our costs incurred to date, we bring our recognized profits or loss. One of them will be present in the question, the two will not be there. So it is either you recognize profit. So whatever profit you recognize here, that is what you're going to be bringing here. If the contract was a loss and you wrote off all the loss, which is what the principle said we should do or the standard says we should do, then you bring that loss. Then the amount you invoiced to the customer for the amount they are supposed to give you during the period will also be what? Brought, and if it is still positive, that means that it's a contract asset. You still have more money to be received from the customer, and that goes under current liabilities in relation to that. However, if it is a negative, that means that it is outstanding, and we will have to take into consideration that and pay the customer, meaning that we are owing the customer in relation to that. So now that we have the principles, we've got all the principles and all the knowledge, let's pick some questions. I have 3 questions for us to discuss on the conclusion of this standard. So let's look at our questions. So question 1. Alex commenced a 3-year building contract. Alex commenced a 3-year building contract during the year ended 31st December 20X4 and continued the contract during 20X5. Alex commenced a 3-year building contract during the year ended 31st December 20X4 and continued the contract during 2015. The details of the contract are as follows. So let me put the details of the contract down. So this will guide us in our workings. So what is the detail of the contract? So we're working in million. Total contract revenue. Another name for that is price. It's 45 million. Another name of that is the contract price. Okay? So contract revenue is 45 million. Cost incurred to date. So we are giving cost incurred to date. that is 20 million. And then estimated cost to completion that is 12 million. Work certified, that is 15 million. And then stage of completion, stage of completion 70%. And then profit recognized. So in this course, it's more or less like we've been given everything and we are just going to be fixing them inside to solve the question. So contract revenue 45 million, cost incurred to date 20 million, estimated cost to completion 12 million, work certified 50 million, stage of completion already computed 70%, profit recognized is 3.3. Let's see the requirements. Show how this contract will be dealt with in the statement of profit or loss for the year ended 31st December 2015. For the year ended 31st December 2015. So how do we account for this contract for the year ended 31st December 2015? So let's see what we do here. Remember what we said. We would have calculated the profit, calculated the percentage of completion. But in this question for Alex, we've been given the percentage of completion as what? 70%, and we've been told about the profit that we need to recognize as well in relation to that 3.3. Now, this recognized profit was at 2014. I think I need to put the dates there very well. This was at 2014. Then this stage of completion is at 2015. Okay, cost incurred to date at 2015. Very important. Work certified in 2015. Okay, so it's very important for me to put the dates up so that we'll be able to understand what's happening here. So the reason why I realized that we need to put the dates up is that we are dealing with profit or loss for the year ended 31st December 2015, okay? But they started the work during the year ended 31st December 2014. So in the year 2014, the company recognized, so that is recognized already, it's gone, we don't have a problem with that. However, in 2015, this is the cost they have incurred up to 2015. This is the estimated cost to completion. This is the work certified in 2015 in relation to that. Now, remember what I told you. I told you that when we are preparing the statement of financial performance, the revenue could be what? The work certified. So in a question like this, you realize that they've done the work in 2014 and we are in 2015. So since we are in 2015, it means that the revenue to be recognized in 2015, we cannot do 70% of the contract revenue. Are you following me? We cannot do 70% of the contract revenue because part of that has already been recognized in 2014. So in 2015, all we have to recognize is what? The work certified in 2015. So let's put our pro forma down in relation to how we answer that question. So let's go. So let's see how much profits the company is making on the contracts. So million, we go about that. So the total revenue from the contracts, how much do we have? 45, okay? Because we need to find out whether we are making a profit or loss on the contract. Then total cost. Now remember, so far we've incurred a cost of 20 million plus estimated cost to complete is what? 12 million. And so that will be 32 million. So when we crunch the numbers, that is giving us a profit on the contract of 45 minus 32, that will be 13. That will be 13 million. Now remember, the work on the job that we have completed so far is 70%. So of this profit, we will only take 70% of that profit going into the income statement. But look at something that is going to happen here. So the profit that we need to recognize is going to be at what? 70% of the 13. Now 70% of our 13 is 9.1. 9.1. So for the entire 70% work that we've done, we are going to be recognizing what? 9.1 as what? The profit. But remember, I told you that we are in 2015, but the job started in during the year ended 2014. So they have already recognized what? 3.3 in relation to profit for 2014. So if total profits recognizable is 9.3 and they had already recognized 3.3, then this year, that is the year ended 31st December 2015, what profit will we recognize? We must deduct the 3.3 from the 9.1. What we get is the profit that we recognize for this year. I hope you are getting the concept very well. Because from our question, we were told that the company started the job during 2014. So throughout 2014, they recognized a profit in relation to the contract, 3.3. From our workings, the total profit is 13. But we finished the job from last year till now, 70% of the job. So the total profit we can recognize is 9.1. But since last year, the entity had recognized 3.3, then this year, we will only recognize what? 9.1 minus 3.3 in relation to that. Then remember also, I mentioned that because we are now in the second year of the contract, the revenue that we're going to be bringing in our statement of financial performance will be what? The work certified, which is the 15 million. Which is the 15 million. So let's put our income statement down. So the statement of financial performance. So we're going to have revenue. So in this case, remember this is for the year ended 31st December 2015. So for the year ended 31st December 2015, the revenue we're going to be bringing will be the same as WC, which is the work what? Certified, okay? WC work certified. So the work certified for 2015 is $15 million. Then how much profits must we recognize in 2015? So we pretend to close this account up, then we bring the profit. Now remember, from our workings, we are supposed to recognize profit of 9.1 million, but they have already recognized 3.3. So we deduct that. So for 2015, the profit that the company can recognize, it will be 5.8. 5.8. So now, if you check it out, the balancing figure will become cost of sales. And 15 minus that will give you 9.2. I hope you are getting the picture. So this is how we go about it. Very simple, sweet, straight to the point. No headache here. But the most important thing is this, that it is the second year of the contract. If it was the first year, we wouldn't have used the work certified. We will have to use the percentage of completion, and then profit recognized wouldn't have what? Been given to us as well. So that is the answer to that question. Now let's look at our second question in respect of that. And this is Evelyn. This is Evelyn. So let's look at it. Now remember, if you have any questions, put them in the chat box if you are watching live, or put them in the comment box, because I look at all your comments, I read them, and I reply to all your comments. If there is anything that you want us to cover as well, put it in the chat box. But most importantly, I want you to subscribe to the channel and share the channel with your colleagues on campus, with your colleagues at the workplace, on social media, everywhere. Spread the news every weekday, Monday to Friday. Nhyira Premium goes live on YouTube, and I teach things like this to assist you so you can prepare well for your examination. So let's move on to our next question, and that is Evelyn. So listen to the question on Evelyn well. Evelyn commenced a building contract in 2015. So listen carefully. Evelyn commenced a building contract in 2015. That has seen large increases in future costs to complete. That has seen large increases in future costs to complete. The contract will be completed on schedule in 2016. The details from the year ended, or for the year ended 31st December 2015 are as follows. So in this question, they started the job in 2015, and it is in that same 2015 that we are being given records for. So let me put down what we have here. The items still the same. So we have contract price, cost incurred to date, estimated cost to completion. We don't have work certified here, but we have stage to completion. So I just want to clean some things up so I don't have to repeat myself a lot. Okay? So this is Evelyn. Evelina. So Evelyn, contract price here is 40 million. Cost incurred to date is 25 million. Estimated cost to complete is 20 million. Stage of completion is 45%. Are you okay? So we have a contract value 40 million. Cost incurred to date 25 million. Estimated cost to completion 40 million. Now off the bat, once you are looking at the data, you realize that the company is making a loss already. Because if you look at the two costs they are incurring, that's going to be 45, but they are going to get only how much? 40. So they are incurring excess cost. But that was stated in the question indirectly because we were told that Evelyn commenced a building contract in 2015 that has seen large increases in future costs to complete. Okay, so that has seen large increases in future costs to complete. So what is the requirement for this question? Show how this contract will be accounted for in the statement of profit or loss for the year ended 31st December 2015. In the statement of profit or loss for the year ended 31st December 2015. So how do we go about it? Simple. We're still going to do this. Alright? Still going to do this. So let me just wipe it up. Our contract revenue is 40 million. The total cost is we've incurred 25, we'll be incurring additional 20 more. And so that's going to be 45. We take it out, you realize that we are making a loss. A loss of how much? 5 million. Now, what did I tell you about the loss? If the company makes a loss like that, what do? We write all the loss off in a year under consideration. So, what revenue do we bring? So let me just clean these guys up. So revenue. Remember how the percentage of job we've done? We've done 45% of the job from the question. So if we've done 45% and it's the first year we are considering, it will be 45% of the contract price or the contract value, so 40%. Then the loss that we recognize, all of the loss will be written off in the current year under consideration. And so 45% of 40 million, we are supposed to get 18. And so the balancing figure, which is cost of sales, will be 23. So when you take this out, it gives you a negative of 5. This is the answer to this question. Now, this is what I want you to do. I want you to be able to distinguish between the first question we solved and this question. You realize that in the first question we solved, we were accounting for the thing in the second year of the contract. But in the second question we are solving, we are accounting for the contract in the first year of the contract. So the accounting are different. You have to be careful whether you are doing for the second year or the third year, or you are doing for the very first year, because that affects how you compute your revenue, and that affects how you recognize a lot of things in the financial statements. So that is for Evelyn. That is for Evelyn as well. So let's look at our final question in that regard. This is Noah. It's called Noah. So let's look at Noah in relation to that. Noah has a 3-year contract which commenced on 1st January 2015. So when did they start the contract? 1st January 2015. At 31st December 2015, Noah extracted the following balances from its ledger relating to the contract. Okay, so let's see the balances Noah extracted. So Noah, we're working with 2 cash columns. So total contract value, that is 140,000. Cost incurred up to 31st December 2015. That is divided into 2. Attributable to work complete or completed, and that is 52,000. Then inventory purchased for use in the future. Inventory purchased for use in the future. That's 8,000. And so that gives us a total of 60,000. Then we have progress billing. This is like invoice that we've given to the customer. So progress billing to date, 45,000 in relation to that. Then cash received, that's 26,500. Then we have other information, and the other information is expected further cost to complete. Expected further cost to completion. Expected further cost to completion, and that is 48,000. So what are we seeing here? In the books of Noah, remember, they started the contract when? 1st January 2015. And we are preparing the extract. This extract is as at 31st December 2015. So that's same year. Now, the total contract value is 140. For the cost that they have incurred up to 31st December 2015 or 20x5, attributable to when they have completed is 52,000. Then inventories that they have bought for use in the future is 8,000. Remember I told you that when you are calculating the cost to completion, it includes both the cost that you have incurred to date and then the cost of inventories that you have bought for use in what? The future. Remember that statement I made? You see how it is structured now in the question here, and we're going to be using it. Then, so the 2 adds up to give us $60,000. Then we come to the progress billing to date. Now the progress billing, like I said, is like the invoice that we've given to the people to pay us how much they are supposed to pay us. Out of that, we've actually received only $26,500. Then other information is that the expected further cost to complete the project is 48,000. Let's see what else we have there. At 31st December 20x5, the contract was certified as 40% complete. So the company has completed the contract 40%. So they are done 40%. So everything that is going to be taken up has to be 40%. But let's see the requirements. It says, prepare extract from the statement of profit or loss and the statement of financial position for the year ended 31st December 2015. For the year ended 31st December 2015. So let's see how we go about it. As always, we need to see whether we are making profit or loss on this particular contract. So let's see if we are making profit or loss on this particular contract. So we're working in 3 zeros up. So total contract revenue. And that is 140,000. Let's see the cost that we are incurring, total cost. The total cost is 60,000, okay? Which is the cost incurred to date, plus the further cost to be incurred, 48,000. And that's going to give us 108,000. When we deduct it, I think definitely we're supposed to get a profit, and that profit should be 22,000. Is that right? Or 30, yeah, 32,000, I guess. Let me see that out. Yeah, 32,000. So that is a profit. So on this contract, we are making a profit of what? 32,000. But remember, it's the first year of the contract, and the percentage of completion of this job is 40%. So we will take only 40% of this. So profit to recognize at 40%. So 40% of 32,000, that gives us 12,800. Okay? 40% of 32,000, that gives us 12,800. So that's the first thing. Then we come to the statement of profit or loss. In our statement of profit or loss, remember, it is the first year. So since it is the first year, we're going to be bringing revenue. And we've done 40% of the job. So we pick 40% of the contract revenue. So 40% of 140,000. And then we will bring our profits to be recognized, which is 12,500 here. Then our balancing figure will be the cost of sales. Okay? Now, 40% of 140,000, that should give us 56,000. So if you check it out, the balancing figure for cost of sales will be 43,200. And that will be in brackets, 43,200. So that is how we deal with the statement of profit or loss, or the statement of financial performance. Alright? For the year ended 31st December 20x5 or 2015. But the examiner also said we should prepare the balance sheet. So if you check the requirement of the question, he said we should also prepare the balance sheet. So how do we go about the preparation of the balance sheet? Remember, before we can prepare the balance sheet, we must calculate the contract asset or the contract liability. So I gave you the pro forma of that as well. The first item that comes is the cost incurred to date. Okay, the cost incurred to date. Cost incurred to date. So if we look at the job that we have done in relation to what is at hand here, what is the cost incurred to date? And that is our attributable to the job that has been completed. So 52,000. All right. Then we have to ask ourselves, what was the recognized profit? In this question, there was a profit. So we bring recognized profit. Remember, I told you it will either be profit or loss. So that's 12,800. That's the recognized profit. And then the next item we bring is the progress billing. That is how much we got or how much we charge what? The customer. Progress billing. That's the same as the invoice. How much the customer is supposed to give us? 45,000. Alright? So when we take it out, we will see that we are going to have 19,800 as an amount outstanding for contract assets. And this is the amount we are going to be receiving from the customer in the future. But at the end of the day, the progress billing we gave was 45,000. But how much did the customer actually give to us during the year? The customer gave us what? 26,500. So the amounts that we are going to be received, so the amount receivable is going to be, will be the 45,000 minus how much? 26,500. And 45 minus 26,500, that should give us 18,500. Okay? So this is the contract asset. That is the amount due from the customer. Okay? The customer is going to be giving us this amount in relation to all the job that we've done so far. But then, based on our invoice that we've given to the customer hasn't paid all the invoice. The customer has paid only 26,500. So we are going to be receiving also 18,500 from the customer in relation to that. So that is what comes in the statement of financial position. Contract assets 18,500 and then receivables. Sorry, contract assets 19,800 and receivables of 18,500. These are the things that you have to understand about revenue from contracts with customers, IFRS 15. So look at the question on NOAA closely. Number one, we computed our profits and we took a percentage of that. Number two, we look at the revenue by taking a percentage. Remember, we are taking a percentage like that because it is the first year. If it wasn't the first year, we would have used the work certified, like the number one question we solved on Alex. Very important. So this is the profit that we made. But at the end of the day, we need to find out and identify what is the cost that we've incurred to date. What is the profit that we recognize? Is money that is due to us from the customer. And what is our progress billing, subtract, and then this is the contract asset. However, the progress billing, the amount we invoice to the customer, he has given us only 26,500. For that reason, he's going to be owing us 18,500. Understand when we talk about IFRS 15, revenue from contract with customers. So if you have any questions, please put it in the chat box for me to look at, or if you are watching the playback also, you put it in the comment box and I'm going to be answering all that as well for you. So that is what you have to understand about this accounting standard. I took my time and it has taken me 2 days to go through the standard. Typically, it wouldn't have taken me 2 days, but I wanted to really build it up in relation to solving of more questions so that we can really appreciate the standard and understand the standard very well in relation to that. So that is it about IAS. I don't know why I still keep saying IAS, but IFRS 15, revenue from contract with customers. So thank you very much for joining us today. God willing, tomorrow at the same time at 4 p.m. I'm going to come live again and we are going to be continuing with our discussion based on topics. It depends. Tomorrow I may do financial reporting or I may do management accounting based on the topics that we have here. If you are watching and there are any topics you want me to cover, you can put them in the chat box and I'm going to be looking at it, or you can put it in the comment box if you are watching the playback of the discussion, and I'm going to be reading all of that and also answer all your questions for you so you can prepare well for your examination. So thank you very much for joining the broadcast today. Very much excited that you make time from your schedules to be able to join me to watch the broadcast. I'm very much excited about it and very grateful. Remember, subscribe to the channel and also remember to share the video with others. Share them on your WhatsApp platform. Share them in your Facebook groups, your Facebook pages. You can tag me when you do this sharing on Facebook, and let's together spread the word and help as much as people as possible, so together we can be in a better position to pass the examination. So again, thank you very much. This is the Business Lecturer in Within Show, where I go live from Monday to Friday to teach 4 p.m. on various subjects, on various topics. And I'll see you same time tomorrow as we continue with our discussion and our journey towards the ICAG May 2020 examination and beyond. I'll see you in our video next. Okay, so Chachu, grateful. Yeah, thank you very much, Chachu. Thank you very much. So keep on following us and keep on supporting. I'll see you tomorrow, God willing.